In this video, we'll break down how to approximate the tax on any Roth conversions and why you might want to consider doing them before the end of the year. If you don't know who I am, my name's Chris Dime. I'm a certified financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. It's not uncommon that as clients accumulate wealth, a lot of that wealth is going to be stored inside of pre-tax retirement accounts. These would be things like pre-tax 401ks, IRAs, etc. And even if someone tries their hardest to fund everything into the Roth portion of their employer-sponsored plan, odds are they're going to have some layer of pre-tax retirement money, and that's solely due to employer match. Up until 2023, employers were forced to make pre-tax contributions if they wanted to do any sort of matching or profit share for their employees. And if you find yourself in this position, it might make some sense to get some Roth conversions done, and we'll touch on why later on in the video, but primarily we'll help you calculate the approximate tax consequence of doing a Roth conversion and why you might still want to pay that tax. So let's jump in. For a quick refresher on Roth conversions, that's where you take a chunk, if not all, of your pre-tax account and move it into a Roth account. Now, most commonly this is done with something like a traditional or pre-tax IRA, and then doing a Roth conversion over to a Roth IRA. But growing in popularity, maybe due to my recommendations, is the concept of doing an in-plan Roth conversion. And that's where you take a current employer-sponsored retirement plan, like a 401k, 403b, or a 457b deferred compensation plan, and inside the retirement plan, do a Roth conversion from a 401k to a Roth 401k, or a Roth 403b, or a Roth 457b. And while this is totally permitted by the IRS, your particular employer-sponsored plan may or may not permit the move. You'll have to check with HR, or you can probably just call the investment custodian that's in charge of the plan and ask them if this is doable. I have not run into a case yet where it's not doable, but I have heard that many plans don't allow in-plan Roth conversions. However much you convert from pre-tax to Roth gets directly added to your gross income for that tax year, and that'll come into play in a second as we do some math on calculating how much you'll owe in taxes, which again are due for that tax year. So the first thing you'll want to do is identify how much money do you have in pre-tax retirement accounts and how much money do you have in Roth accounts. Assuming you can do an in-plan Roth conversion or just a Roth conversion on your own through your IRAs, now we're going to want to figure out at what tax rate would that Roth conversion be assessed. The easiest way to do this, if your financial situation hasn't changed this year much from last year, is just pull up last year's tax return, go down to the bottom of your Form 1040, line 15 will show your taxable income, and you can just use that number. However, if your financial situation has changed a lot since last year, super simple math to figure out approximately what rate your Roth conversion will be taxed at is to grab all your income sources all together, add them up, subtract out the standard deduction, which for a single filer is $13,850, and for someone who's married and filing jointly, your standard deduction is $27,700 for the tax year of 2023. That gives you your taxable income very crudely that we can use for planning purposes. And if you're self-employed or you itemize your tax deductions, your situation might require a little bit more thought, but for the most part, keeping it super simple, that's how to get a taxable income approximation. Now, once you have your taxable income, we can pull up the IRS tax brackets and do some quick math as to how much you'll owe in taxes on your Roth conversion. Let's say hypothetically, my family's in the $200,000 taxable income range. If you look at the married filing jointly tables, that puts me squarely in the 24% marginal tax bracket. Now, this doesn't mean that all $200,000 is taxed at that 24% bracket. It just means the amount of taxable income that's within that band is taxed at 24%, which in this case is only about $10,000. This also means that since my taxable income lands me in the 24% bracket, any money I Roth convert, as long as it keeps me within that band, will also be taxed at 24%. And it looks like I've gotten to a total of $360,000 before I'll start climbing into another marginal tax bracket. And so the simple math there is I could convert $160,000 from a pre-tax account to a Roth account and only owe 24% in taxes on that conversion. And that results in a tax bill of around $38,000. But if I were to choose to convert more than $160,000, the first $160,000 would still be within that 24% bracket, so that is still the taxes I'll owe on that. Any money above and beyond that tax bracket would fall into the 32% bracket, and however much money is within that band is then taxed at 32%. Keep in mind, this only applies to the federal income tax brackets. It does not factor in your state income tax, which you could be assessed, as well as net investment income tax, which requires its own explainer video, but nonetheless, these are other taxes that could be factored in as well. You'll need to check with your specific state, and based on net investment income tax, you'll need to factor in your own brackets compared to those brackets. A super common and digestible method of doing Roth conversions is to Roth convert as long as that Roth conversion doesn't exceed your current marginal tax bracket. Now, I find that to be a much more behavioral finance approach to doing Roth conversions rather than a purely academic one, because academically, as long as whatever you forecast your withdrawal tax rate to be in the future, as long as that is higher than whatever your Roth conversion lands you in from a marginal bracket today, the math makes sense. So even if converting $1 million of pre-tax retirement account, which would land me in the 37% bracket for most of that conversion, if I think I'm going to be in a much higher than 37% bracket in the future, then the math would say to still do the conversion today, or at least to still do the conversion before I get there. That being said, whether you take an academic or a more behavioral finance approach to doing Roth conversions, at the end of the day, we're all trying to capitalize on the same benefit, which is tax arbitrage, which is just a super fancy way of saying the difference in taxes today versus whatever tax rates are going to be in the future on whoever is pulling money out of this account at that point. So some common situations where a Roth conversion would totally make sense is if you forecast your current lifestyle to be much higher in the future, warranting a much higher income distribution from your retirement accounts, thus landing you in a much higher marginal tax bracket at that point in your life. If that's the case, then it would totally make sense to get some Roth conversions done today so that you can pay taxes at today's much more favorable rates than whatever they're going to be in the future. In another situation, even if you expect your lifestyle and income to stay the same, if you forecast tax rates themselves going up between now and when you're pulling this money out in the future, it totally could make sense to get some Roth conversions done today. For example, we know in 2026, unless the Biden administration changes something, the Trump tax cuts that took place a few years ago, those are going to sunset in 2026, thus causing pretty much everybody's federal income tax brackets to go up. So you might look to do some Roth conversions before that period of time. And it's even possible that tax rates could go way up past what they will in 2026. Now, I know you're thinking, Chris, why would you even think that? The US government is only at $33 trillion of debt. And I hear you, but let's just use it as a thought experiment and say tax rates go way up in the future. It would totally make sense from a counterfactual standpoint to pay the taxes today versus whatever your crystal ball says they're going to be way in the future. Even if, adjusted for inflation, your income and lifestyle are probably going to stay the same. Another thing to consider when looking ahead at the future are required minimum distributions. As a refresher, those are the mandatory retirement account withdrawals that the IRS imposes on people in their 70s. And it essentially means that when you're in your 70s, if you haven't distributed your retirement account fast enough, you're going to be forced to take account withdrawals that you might not even need. And when I say you don't need it, it just means that the withdrawal is going to exceed what you need to pay all your bills in retirement, which unfortunately just means you get to pay income taxes on money you don't need. And odds are, when we do the math for our current clients, the math is far more advantageous to layer in Roth conversions between now and when the client reaches their 70s, when they have to pull out RMDs. It generally makes way more sense to layer in Roth conversions over time to avoid needing to take out required minimum distributions and then paying a much higher effective tax bracket on that stuff in the future. On the topic of RMDs are the new beneficiary guidelines for those who inherit retirement accounts. The majority of people, when they inherit a retirement account, are going to have a 10-year window when they need to withdraw the entire account balance. The stretch IRA no longer applies to as many people as it did before. And what that means is whoever inherits your retirement account, they have 10 years to liquidate the entire account. They may or may not have required minimum distributions every single year. That's based on the type of beneficiary they are, and you can check out some of my older videos on that. Ultimately, if you forecast your beneficiaries inheriting this money, they might be at a much higher tax bracket than you are in retirement. And if that's the case, it might totally make sense to get those Roth conversions done today so that whoever you pass these funds on to, they can inherit Roth IRA money, which means, yes, they still have to liquidate it within 10 years, but the liquidation is tax-free and very similar to your own required minimum distributions. Even if whoever's going to inherit this money is not at a higher tax bracket, keep in mind your very large retirement account that you are planning to take withdrawals out of for your entire life, if they have to withdraw the entire account within 10 years, again, that's a much higher effective tax bracket on every single withdrawal. It still could make some sense to get some Roth conversions done out of the way. But let's say you've done the math and you need every penny for your retirement, which is totally fine. Just know that any pre-tax retirement withdrawals you make in retirement will affect the amount of Social Security that is taxable. This is called your provisional income. It's a separate calculation the IRS does to determine how much of your Social Security retirement benefits you get to pay income taxes on again. And any pre-tax IRA withdrawals in retirement will push up how much Social Security is factored in. I have an explainer video on that you can check out on the channel, but it's called provisional income. And if you withdraw Roth money, tax-free money, then that will not affect how much of your Social Security benefits are going to be subject to income taxes. And then last thing that comes to mind for a retiree is the effect of Medicare Part B premiums, also known as IRMA, or Income Related Monthly Adjustment Amount. Said another way, if you make too much money in retirement, you get to pay a higher premium for Medicare Part B. So taking pre-tax IRA withdrawals past the age of 62 could affect how much more you have to pay for Medicare Part B. And I say past the age of 62 because Medicare does a 2-year look back where they look back at the previous 2-year tax return to determine how much you'll owe today in income-related monthly adjustment amount Medicare Part B premium. Said another way, for Medicare you're forecasting to get in 2025, the IRS is going to look at your 2023 return to say, here's how much money you made, great. Here's how much more you get to pay in the future. So it's definitely something to consider if you're close to those Medicare ages, is ensuring you don't trip up and fall into IRMA brackets. And the faster you get your Roth conversions done, the less likely you are to have those jeopardize your IRMA. That also means that you should probably time when doing the Roth conversion so that your Roth conversion in and of itself, because again, that's taxable income, doesn't factor into that 2-year look back tax return. So a few things before we wrap up. Number one, any Roth conversions you make, yes, increases your taxable income, but it does not increase your modified adjusted gross income for the purposes of qualifying for Roth IRA contributions. From a logistics standpoint, if there's a certain amount of money that you for sure want to convert, I would recommend raising that in cash first and then doing the Roth conversion. That way, the number doesn't fluctuate. Unfortunately, most of the time what I see is people pick a certain number of securities or particular lots within a security, and then they do the Roth conversion based on that. As you know, securities change in value every day, and unfortunately, if you're planning on a particular sum of money to be Roth converted, and then the securities go down or up, then your estimation is going to be off. Because it's not a 24-hour period. Sometimes the financial institutions can take a while to get around to your request, and a few days later could drastically affect how much gets converted, and then subsequently how much you'll owe in taxes. Another thing I would look out for when doing a pre-tax IRA to Roth IRA conversion is any non-deductible IRA money you might have put in the past. So that's where you fund an IRA, but you don't take a tax deduction. But ultimately, when you convert that money over to a Roth IRA, you're going to want to make sure your math is correct and that you don't accidentally pay taxes again on the non-deductible IRA contributions you already didn't take a tax deduction on. Another best practice is to not pay the Roth conversion tax out of your retirement account. So even if you're past the age of 60, but definitely if you're under the age of 60, don't pay the Roth conversion taxes out of your IRA. If you're over 60, you then have to include that in a taxable distribution, which costs more in taxes. So it's kind of like a dog chasing its tail. You don't want to do that if you can avoid it. But definitely if you're under the age of 60, you don't want to pay income taxes on however much money you're pulling out to pay the tax and a 10% penalty tax on top of that. That's just not the best financial strategy. Pay the estimated taxes out of your pocket or out of some other type of investment account, like a joint non-retirement investment account or an individual non-retirement investment account. And the last thing I would say is as you're doing this planning and deciding if a Roth conversion is right for you, I would analogize it to making an irrevocable retirement plan contribution. Yes, it's probably in your best interest if you've done the math correctly to do this. However, it's a binary trade. Once you put the money inside of a retirement account, you can't put that money towards anything else. So if you've got competing goals, weigh the pros and cons. It may or may not be in your best interest to do this right now, just based on where the family's at and kind of what you're up to financially. Hopefully that was helpful. If you have further questions, drop them in the comments below. Get in touch on the website. We'll get you squared away. Have an awesome rest of your week. We'll talk to you later. Bye.